My dear students, welcome back to our channel. In this video, I will be explaining the BBA second semester subject Financial Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1, the important short question is: what are the limitations of accounting? Limitations of accounting. While accounting is helpful for recording and understanding business activities, it also has some limitations. Key limitations. 1. Ignores non-monetary things. Accounting only records what has money value. It cannot record employee skills, honesty, or brand reputation. 2. Based on historical data. It records past transactions, not future plans or market changes. 3. Does not show real value of assets. Assets are recorded at original cost, not current market value. 4. Can be affected by personal judgment. Some things like depreciation or stock valuation depend on the accountant's personal judgment. Example: if a machine bought for 1 lakh rupees is now worth 50,000 rupees, accounting may still show it as 1 lakh rupees based on original cost. Easy tip to remember: accounting is useful, but not perfect. It misses things money can't measure. Next important short question is: to briefly discuss the GAAP. GAAP stands for Generally Accepted Accounting Principles. These are a set of rules and guidelines that all accountants follow while preparing financial statements. Why GAAP is important? Makes accounting uniform and standard. Ensures accuracy and honesty. Helps in comparing financial reports of different companies. Example: imagine two students writing exams. GAAP is like a common set of rules that both must follow, so the teacher can fairly compare their answer sheets. Key GAAP rules include: 1. Going concern, business will continue running. 2. Consistency, same method every year. 3. Accrual, record income expense when it happens, not when cash is received. Easy tip to remember: GAAP is equal to golden rules of accounting. Just like traffic rules keep roads safe, GAAP keeps accounting clear and fair. Next, Unit 1. Long questions. First important long question is: is accounting an information system? What is its importance in modern corporate environment? Is accounting an information system? Yes, accounting is an information system. It works like a data system that collects, records, processes, and gives useful financial information to help in decision-making. How is accounting an information system? Just like a mobile phone stores contacts, messages, and photos, accounting stores financial data of a business. It gives reports like profit and loss account to see profit or loss, balance sheet to see assets and liabilities, cash flow statement to see money in and out. These reports help business people, investors, and managers to make smart decisions. Example: if a company earns 5 lakhs rupees and spends 4 lakhs rupees, accounting will clearly show a profit of 1 lakh rupees. This helps the owner plan future investments, salaries, and expenses. Importance of accounting in the modern corporate environment. 1. Helps in decision making. Managers use accounting information to plan budgets, control costs, and grow the business. 2. Legal requirement. Companies must keep proper accounts and pay taxes as per law. 3. Attracts investors. Investors check financial reports before investing. Accounting builds trust. 4. Tracks financial health. Tells whether the company is making profit, facing loss, or in debt. 5. Easy comparison. Accounting follows GAAP, so it's easy to compare performance of different companies. 6. Audit and transparency. Helps auditors check the correctness of financial statements. Increases transparency. Easy tip to remember. Accounting is equal to business ka report card bar chart. Just like students get report cards, companies get theirs through accounting. Conclusion. So yes, accounting is an information system that is very important for running, growing, and controlling any modern business. It helps everyone, from owners to government, to understand the true picture of a company's money matters. Next important long question is: to write about the importance of accounting. Importance of accounting. Accounting is the language of business. It helps a business to record, track, and understand its money. Without accounting, a business would not know how much it earned, spent, or saved. Why is accounting important? 1. Keeps financial records. Accounting keeps proper records of all transactions like income, expenses, loans, and assets. Example: if a shopkeeper sells goods worth 10,000 rupees and spends 6,000 rupees, accounting will record both and show a profit of 4,000 rupees. 2. Helps in decision making. Owners and managers use accounting reports to make decisions like: should we invest more? Can we reduce expenses? Are we making profit? 3. Legal requirement. All businesses must keep accounts for paying taxes, following government rules, auditing. 4. Helps in planning and budgeting. With accounting, a business can plan future income and expenses by looking at past performance. 5. Attracts investors and banks. Investors and banks check a company's balance sheet and profit and loss account before giving money. If your accounts are clear, people will trust your business. 6. Shows financial position. Accounting helps to know how much the business owns, assets, how much it owes to others, liabilities, how much is the actual worth, capital. Easy tip to remember. Accounting is like a mirror, it shows the true face of the business. Summary. Benefit: why it matters. Records transactions, keeps everything in writing. Supports decisions, helps in planning and growth. Legal need for tax and audit. Builds trust, useful for investors and banks. Accounting is essential for all types of businesses, big or small. It helps them to run smoothly, grow confidently, and stay legally safe. Next important long question is: 3. Write about the scope of accounting. Scope of accounting. Scope of accounting means the areas or activities where accounting is used. Accounting is not just about recording money, it helps in many areas like planning, control, analysis, reporting, and decision making. Let's understand how wide the scope of accounting is. 1. Recording financial transactions. Accounting records all money-related activities of a business. Example: sales, purchases, salaries, rent, etc. 2. Classifying and summarizing data. Accounting groups similar transactions and summarize them into reports. Example: monthly sales, total expenses, etc. 3. Preparing financial statements. It helps prepare important reports like profit and loss account, balance sheet, cash flow statement. These show if the business is profitable and healthy. 4. Decision making. Owners and managers use accounting to make business decisions. Example, should we increase salary? Can we buy new machines? 5. Tax and legal compliance. Every business must follow government rules and pay taxes. Accounting provides the data needed for GST, income tax, and audits. 6. Cost control and budgeting. Accounting helps in tracking costs and creating budgets. Example, setting monthly budget for electricity or raw materials. 7. Helps in investment. Investors use accounting reports to decide whether to invest in a company. Example, a good balance sheet attracts more investors. Easy tip to remember. Scope is equal to statements, control, owners, planning, expenses. Conclusion. The scope of accounting is very wide and useful. It is needed in every business, government office, bank, and even for personal finance. Accounting is the backbone of financial management. Next important long question is 4. Write about the uses of accounting information. Uses of accounting information. Accounting information means the details we get from accounting records, like profit, expenses, assets, and liabilities. This information is very useful for different people in the business world. Let's understand who uses it and how. 1. Business owners. They use accounting information to check: is the business making profit or loss? What are the total assets and liabilities? Example, a shopkeeper checks his profit using the profit and loss account. 2. Managers. They use accounting to make smart decisions like controlling costs, planning future budgets, improving performance. Example, a factory manager checks how much is spent on raw materials. 3. Investors. Before investing in a company, investors want to know: is the company earning profit? Will they get good returns? Example, people check the balance sheet of a company before buying its shares. 4. Creditors and banks. Lenders want to know if the business can repay loans on time. Example, a bank checks the company's financial report before giving a loan. 5. Government. Government uses accounting info to collect taxes, GST, income tax. Check if companies are following rules. Example, Income Tax Department uses accounting data for tax calculations. 6. Employees. Employees use it to know: is the company financially strong? Can they expect bonuses or job security? Easy tip to remember. Big CG is equal to banks, investors, government, creditors, employees, general public. Conclusion. Accounting information is not just for accountants, it helps everyone connected to a business. It gives the true picture of the company's money and helps in better decisions. Next important long question is 5. Discuss in detail about accounting principles. What are accounting principles? Accounting principles are the basic rules and guidelines that every business must follow while recording and reporting financial transactions. They make accounting honest, clear, and easy to understand. Think of them like traffic rules. All drivers must follow them to avoid confusion and accidents. Similarly, all accountants follow these principles to keep accounting correct. Important accounting principles. 1. Business entity principle. A business is separate from its owner. Example, owner's personal expenses are not shown in business accounts. 2. Going concern principle. Assumes the business will continue running in the future. Example, assets are not sold at market price, even if the owner is sick, unless the business is closing. 3. Money measurement principle. Only transactions with money value are recorded. Example. Staff honesty is important, but it's not recorded because it has no rupee value. 4. Cost principle. Assets are recorded at their original purchase price, not current market value. Example, if a building was bought for 5 lakh rupees, it's shown as 5 lakh rupees even if its value becomes 10 lakh rupees. 5. Accounting period principle. Financial records are maintained for a specific period, monthly, yearly. Example, companies prepare reports for April to March financial year. 6. Accrual principle. Record income and expenses when they happen, not when money is received or paid. Example, if rent for March is unpaid, it is still shown as an expense in March. 7. Consistency principle. Use the same methods every year for better comparison. Example, if depreciation is calculated using the straight line method, it should be continued next year too. Easy tip to remember. Big green mangoes can always add color consistently. Business entity, going concern, money measurement, cost, accrual, accounting period, consistency. Conclusion. Accounting principles bring uniformity, trust, and clarity to financial reports. They are the foundation of good accounting. Next important long question is 6. Write about the concepts of accounting. Concepts of accounting. Accounting concepts are the basic ideas or assumptions used while preparing financial statements. They help in making the accounts clear, honest, and reliable. Just like we follow basic rules in maths, we follow concepts in accounting to make sure everyone understands the reports in the same way. Important concepts of accounting. 1. Business entity concept. The business is separate from the owner. Example, if the owner takes 10,000 rupees from the business for personal use, it is recorded as drawings. 2. Going concern concept. The business is expected to run for a long time. Example, we do not show all assets for sale even if their value goes down. 3. Money measurement concept. Only things that can be measured in money are recorded. Example, good customer service is not recorded, but a 5,000 rupee sale is. 4. Cost concept. Assets are recorded at original cost, not current market price. Example, a machine bought for 50,000 rupees is shown at 50,000 rupee even if its value becomes 40,000 rupees or 60,000 rupees. 5. Accounting period concept. Accounts are prepared for a fixed time period, monthly, quarterly, yearly. Example, a company may prepare financial statements for April to March. 6. Dual aspect concept. Every transaction has two effects, debit and credit. Example, if you buy furniture for 10,000 rupees in cash, furniture increases and cash decreases. Easy tip to remember. Big Mac is equal to business entity, income period, accounting period, going concern, money measurement, assets at cost, dual aspect. Conclusion. Accounting concepts are the base or foundation of the accounting system. They make sure the business records are true, fair, and easy to understand for everyone, from owners to investors. Next important long question is 7. What are accounting conventions? Explain them. What are accounting conventions? Accounting conventions are the practical rules or customs followed by accountants over time. They are not official laws, but they are commonly accepted to make accounting fair, consistent, and understandable. You can think of them like manners or good habits in accounting that everyone follows. Important accounting conventions. 1. Convention of consistency. The same accounting methods should be used every year. Example, if you use the straight line method for depreciation this year, you should use it next year too. Why? So financial results can be compared over time. 2. Convention of full disclosure. All important information should be clearly mentioned in the financial statements. Example, if the company has taken a big loan, it must be shown in the balance sheet. Why? So investors and others can take informed decisions. 3. Convention of conservatism, prudence. Always be cautious. Record expected losses, but not expected profits. Example, if a customer may not pay 5,000 rupees, show it as a bad debt. But if you expect 5,000 rupee profit from a future deal, don't record it yet. Why? To avoid showing a false picture of profit. 4. Convention of materiality. Only record things that are important and significant. Small items can be ignored. Example, if you buy a pen for 10 rupees for office use, you can show it as an expense, not as an asset. Why? To keep accounts simple and focused on important items. Easy tip to remember. CCFM is equal to consistency, conservatism, full disclosure, materiality. Conclusion. Accounting conventions are accepted ways of doing things that make accounting more realistic, reliable, and useful. They help in showing the true financial position of a business in a simple and honest way.